I bought a new stock, and I should have been wearing green for this video because it's Duolingo. And I can explain why. Because it is said that the best investments are the easiest ones to explain. And now this one is easy. It's really easy. Because I'm relying on, well, all the models and AI to carry this investment for me. Now, the stock hasn't done that well in the last few weeks, but I'm confident this won't last. So let's go through the business, the valuation, the growth, and the opportunities this business has. And also why I think this is such a good and AI focused investment. So let's start with the business, because Duolingo has the mission to develop the best education in the world and make it universally available. Now, currently, Duolingo offers courses in 42 languages, of which 40 are for English speaking users. Now, besides the music courses, Duolingo also offers mathematics courses and music courses. So they are expanding a bit into different categories apart from the languages alone, what the business or the company is basically so well known for. Duolingo offers these courses through a freemium model, so you can get this app for free. And if you do so, you get ads, which Duolingo, of course, makes money on. Now, if you don't want the ads and you want to get additional benefits, you can, purchase a membership. And depending on the membership, you get additional features and, no ads. This is how Duolingo makes their money, and this is often a very highly valued business model by Wall Street. We can also see that in the stock price or in the valuations. But first, let's take a look at the stock price, because like I already mentioned, the stock did sell off a bit in recent weeks. Now, despite this recent sell-off, the business still has a $7.5 billion market cap, which, for the stock market isn't that big, but for a language learning app, that might be more than you expect. At least, I expected the business not to be this richly valued or have this market cap. Now, the trailing 12-month PE is about 176, so that's very high. And the forward PE is over 100. This is still extremely, extremely high. And I will give comments later on why I think it's a bit disturbed or distorted. But a 100 forward PE is something that's normally not on my list either. Now, the price to sales is 14, which is a bit less spectacular than a 100 forward PE, but it's still quite up there. And I mean, just overall, the valuations, it does look very, very expensive at this price. And in most regards, it is. But there's one metric I'm going to point you towards later that tells you a bit otherwise. Now, a 100 forward PE, like I already mentioned, is just extremely high. And that's also, like I said, high for my standards. But there are ways in which a company can justify a higher PE or higher forward PE. And one is through high growth, and the other is through a very stable business model. Now, the business model that Duolingo uses is through a membership business, and that's, of course, quite stable. People get subscriptions and they get, recurring revenue from those people. So that's one justification, but that doesn't really justify a 100 forward PE in and of itself. However, when we couple that to the growth, we can see that daily active user growth of 54% year over year. Now, this was during Q1 2024, and in a short period, Q2 will come out, so I will review the numbers then again. And the monthly active users increased by 35% year over year. So this is very strong growth. And where it becomes even more impressive is with the paid subscribers. That went up by 54% as well. Now, that's that's a very large amount. And the paid subscriber penetration went from 8% to 8.6%. So that went up about 6 basis points. And that's very important as well, because that means that they get more efficient with their value proposition, with selling the subscription, the membership. So that's very important to see growth on that number as well. And if we look at how that translates to the revenue, we can see that went up 45% year over year. Bookings went up 41% year over year. And they switched from a net loss to being net profitable. Now, the adjusted EBITDA went from 15.1 million to 44 million, and they went to a 26.3 adjusted EBITDA margin. Now, they do want that margin to be a bit lower and invest more in growth. However, those opportunities weren't really there in that quarter. But you can expect that number to come down a bit as they just start investing more and get more investment opportunities into their growth. Now, the difference between the bookings and the revenues is more of an accountancy difference. Bookings is anything that I tell you, oh, I'm going to buy it. And revenue is when they can actually realize it. So there is a slight difference in that. And for me personally, I just prefer to use the revenues, but the bookings can give a good insight. So when we look at the underlying metrics for that revenue growth, we can see that the decimal number for the revenue growth was 44.87%. So that's very good. And we saw the cost of revenues increase by 43.5%. Now, whenever the cost of revenues increase at a lower pace than the increase of revenues, that's always good. Doesn't matter by how much, the more the better, but even a slight bit, that's very good. Now, the gross profit therefore went up more than the revenues went up, and that's a very good sign. That's a good sign for a good business. Now, the total operating expenses only went up 14.2%. And, well, what we saw from that is that the net income that went from, like I already mentioned, negative 2.5 million to positive 26 million, 26.9 million. And also the EPS, the net income per share attributed to common shareholders on a diluted basis, that went from negative 6% to now being positive 57%. So that's an incredibly large shift. So if we look at how these numbers compare on an historical basis, we can see that over the last 10 years, the revenue grew at almost a 20% CAGR. On the last 5 years at a almost 43%, and in the last year 45%. So over the last 5 years, we've seen it regularly a little bit over 40% basically, and prior to that, closer to 20. Now, that's very impressive growth, and that also tells us that it's not just a one-off year, and that's very important. Now, we can also see the free cash flow, and the free cash flow has been increasing by 40% over the last 10 years, by 90% over the last 5 years, and by 180% over the last year. So that's, very strongly accelerating. And maybe that 180% isn't as relevant for the future, but seeing free cash flow jump up as much as it does, that's quite telling for a membership or subscription business. These businesses have those characteristics. The free cash flow just jumps up incredibly fast. Another business I hold that has the same is Monday, for example. They use a seed licensing agreement, and their free cash flow also jumps up a lot due to the recurring revenues. Now, we also see the stock-based compensation in this metric. That's the purple bars. And that's good to hold besides it, because here we can see that the free cash flow isn't really jumping up, or the stock-based compensation, isn't jumping up as much over the last few quarters as one might suspect. They do keep that stock-based compensation relatively well in check. And that's something that's very good to see. Very much explosive free cash flow growth, but not as much stock-based compensation growth. That's also another positive sign. And like I already said, the metric that therefore isn't making this company look as expensive as the forward PE is the dividend yield, because the dividend yield for this business at a share price of about $180 is around 2.5%. That's about market average, but for that market average, you get 45% revenue growth. And the EPS growth, since they just made that flip towards profitability, is even far greater. And it isn't that diluted by stock-based compensation. Now, they did say they want to hire some people for re-accelerating growth or maintaining their growth. So it might pop up a little, but I don't suspect to be it that much. Now, like I already said, the EPS number that has been going from negative to positive basically in the last year. So Q1 2024 was the fourth quarter of profitability, but I don't think it will go under it anymore due to the stableness of this subscription model, basically. Okay, so then we know the business, we know the valuation, that it's expensive, and we know why it is because we know the growth. So then it's time to look at the opportunities this business has. And basically they gave it to us in their last earnings release. because they gave us their, well, expectations for 2024. And, well, I made this nice little print screen from it where they saw their opportunities. But where they see them is basically also where I see them. Well, I can summarize them with an increased rollout of Duolingo Max and the family plan. Now, it might be important to know or good to know what these plans are. And this is also where I said that Duolingo comes in as a true AI stock. Now, the Duolingo Max tier is where I say that Duolingo is a true AI stock, because Duolingo Max uses generative AI in order to, well, increase the experience that a language learner has with the business there or with Duolingo. There's more interaction because, well, with AI, you can generate more interaction. Now, as you can see here, they use the open AI models for it. And Duolingo is actually making additional revenues through AI. This is in my last video where I backed a bit on some other companies where they say, oh, we are AI, but they have no revenues to show for it. Duolingo has revenues to show for AI. They do use it. They have an additional tier, which is more expensive, and it can only, well, that's only made due to AI because they can improve the business with AI and, well, get a higher subscription fee for it. Now, there are some negative to this tiers, and one is that it's pressuring margins a bit. We can see it in the transcript from the latest earnings release, where basically they said, right now, I feel pretty good about our dollar margin on Max, Max being Duolingo Max. And I think ultimately the gross margin will be just fine. So they said in this earnings call, or maybe one prior to it, one of the earnings calls, that on a dollar basis, Super Duolingo, I keep saying Super Duolingo, but Super Duolingo and Duolingo Max have about the same dollar margin. So the gross margin for Duolingo Max is a bit lower, but that's also due to the fact that, well, they use the generative AI for it. Now, they do have another use for it, but first let me explain the other opportunity I see for this business, and that's the family plan. And that's also what I stated in my intro. The family plan is that I expect the mothers to carry this investment for me. Because who doesn't want his kid or her kid to, well, to excel in school? And having language learning with it, that's just gonna help. And doing this at home helps a lot, especially when one of the parents can look into how everything is going and if the child is actively participating in his lessons. Now, like I said, that is where I see this opportunity because people will stick around longer. The price is slightly higher, people will stick around longer. That's a very good combination. And that's also what was said in the last earnings release, because for the financial part of the questions, we've often found that family plan has a much better retention characteristics and much higher ARPU for companies. Pretty price elastic. I do believe that they have quite a bit of pricing power in the family plan. And why do I see this as such an opportunity is because they basically were a bit, or they neglected this plan a bit. There was some bug that one of the parents or the owner of the account couldn't see the progress in other accounts or couldn't see who was connecting to the account. So they really neglected this part of the business. And that's not something that's very positive, but it does give an opportunity. Okay, now, like I just said, they also have another use for AI, and that is that they can create the lessons much faster and much more efficient. Because, well, generative AI is expensive, of course, but if you have to create the entire lessons, get different challenges, all done manually by people themselves, solely due to the length that it takes or the time that it takes and the salaries you have to pay for it, that's going to be more expensive. It's just simply cheaper to run it through generative AI and you get, well, more lessons quicker. So that's what they are using AI for, and they use it therefore for additional revenues and for more efficiency. So, like I said, Duolingo is basically an AI company, how crazy as it sounds. Now, beyond 2024, they have also additional goals or growth targets. Now, beyond 2024, they have two main growth drivers, as they said themselves. They state four, but they have basically two. The first one is the massive collection of data, because they can run hundreds of experiments each quarter, and they can combine that with AI to create a more personalized learning experience. So this should help the retention rate, the engagement, and it should just make people want to use the platform more. Now, the other positive they have going for growth is the more brand awareness. And they said themselves that especially their mascot Dio, well, the green owl, have become synonymous with gamified learning. And I agree. Whenever I see it at all, and maybe it's because I know it, but I see Duolingo. Whenever others see that all, I think they connect it to Duolingo pretty fast as well. And Duolingo is very good at marketing. They know really well what to do because they started out on TikTok and they really got good engagement over there. And they basically said, okay, we're going to diversify away from TikTok, and they implemented YouTube Shorts, Instagram Reels, and they said, well, the business there is slightly different. We know that. But the things that work on TikTok also work pretty decently with a few minor twitches, two Reels and two Shorts. So that's very positive. They know their marketing, they know what's iconic for them, they know that the owl is very important for them and the brand that it brings. So, all in all, I think this is a very good business. I just really like the subscription model. I like the brand awareness. I like how they can implement AI. And I like, well, like I already said, I think the family plan is going to carry this business, well, for a great deal in the future. Um, so, with that said, thank you for watching. If you have any comments or things I haven't seen in this analysis, please let me know in the comments below and subscribe to my channel. Now, thank you for watching.